$81.99 in Shanghai, $79.57 in New York. That $2 gap you see on the screen right now is not a pricing error. It is not a temporary arbitrage opportunity. It is a structural break in the global financial system that went live at 9:23 a.m. Beijing time on December 26th. This is the moment the Chinese export licensing regime activated, and the paper price of silver began its final collapse under the weight of physical reality. The disconnect is here. The shockwave has arrived. That $2.42 premium on physical silver in Shanghai is the most important number in the world right now, and almost no one understands why. It represents a fundamental pricing failure in the West. For decades, the price was set in New York and London by paper contracts derivatives that created the illusion of infinite liquidity. But on December 26th, that illusion shattered. The moment that number flashed on trading screens, every major bullion dealer on the planet knew the system was broken. The Shanghai Gold Exchange instantly became the new benchmark because it was trading something the West could no longer reliably deliver: actual metal. This wasn't about futures or promises. It was about metal in a vault available for immediate withdrawal. The COMEX, with its vast paper edifice, was exposed by a single undeniable data point. The gap tells you everything. It tells you that the physical market in the East has decoupled from the paper market in the West. It tells you that buyers with urgent, non-negotiable industrial demand are willing to pay a premium to secure metal before the door closes. And most importantly, it tells you that this premium is only the beginning of the dislocation. Think of it like a levee breaking. The first sign is a small trickle of water, a tiny crack. That's what we saw in late October when the announcement was made. The market shrugged, but December 26th wasn't a trickle. It was the moment the wall gave way. The pressure differential between the physical reality in Asia and the paper fiction in the West became too great. This gap is a signal that the foundational premise of the silver market, that paper claims can infinitely outweigh physical metal, is now invalid. The East is pricing scarcity. The West is still pricing abundance. And on January 1st, when China's licensing regime takes full effect, that gap won't narrow. It will explode. The $2.42 premium is the warning tremor. The main event is just days away. So what is this licensing regime that just flipped the entire market on its head? It all traces back to a single-page document from the Chinese Ministry of Commerce, Announcement 68, issued on October 30th. Most Western media called it a bureaucratic formality. They were catastrophically wrong. This isn't a quota system. It's not a tax. This is total governmental control over the physical movement of silver. Every single gram of silver that leaves China after January 1st requires an individual license approved by the Ministry of Commerce. Each application is reviewed case by case. The destination country, the end user, the intended purpose, all of it is subject to government scrutiny. The stated reason is to ensure orderly development of the industry. The strategic reality is a weaponization of supply. This mirrors China's playbook with rare earth elements a decade ago. First, you control the refining capacity. Then, you implement export controls under the guise of environmental regulation or industrial policy. You create a choke point that the rest of the world cannot bypass. The 30-day review period written into Announcement 68 is a de facto embargo. For an entire month, the global market has to operate on the assumption that zero silver is coming from China. In a market that depends on a 6,000-ton annual export buffer, a 30-day silence is a declaration of war. The conditions attached to any preliminary approvals are even more revealing. Exports only to approved countries. Report every shipment within 24 hours. The government reserves the right to revoke a license at any time, for any reason. This isn't a system designed to facilitate trade. It's a system designed to grant Beijing instantaneous leverage over any nation that relies on this metal. If Europe imposes tariffs, China can cut silver. If the US sanctions a Chinese tech firm, China can cut silver. The metal has been transformed from a commodity into a strategic asset. The initial market reaction in October was a $3 move, a mere blip. Analysts dismissed it as a negotiating tactic. They assumed the licenses would be issued freely. But by mid-November, the truth emerged. Small and medium-sized exporters, the companies that had been shipping metal for decades, found their applications under indefinite review. Only the state-owned giants, the entities with direct party ties, were receiving any kind of preliminary nod. The message was clear. The flow of silver is now a matter of national strategy, not free market economics. This move was never about generating export revenue. The entire annual export volume of silver is worth roughly $5 billion at current prices of rounding error in China's trillion-dollar trade surplus. This is about securing the foundation of their own economic transformation. It's about ensuring that every gram of silver they refine is available for their solar panels, their electric vehicles, their 5G infrastructure. The green energy transition is a national security priority, and silver is the irreplaceable conductive element that makes it all work. By locking down exports, China is not just influencing the price. They are guaranteeing their own industrial dominance for the next decade. The West fundamentally misunderstood this announcement because they viewed it through a narrow financial lens. They saw a potential disruption to a derivatives market. Beijing saw a long-term strategic necessity. The 30-day review period isn't a delay, it's a countdown. It's the time the West has to realize that the rules of the game have been permanently rewritten. The disconnect we saw on December 26th was the first symptom. The cause was set in motion on October 30th. The system isn't cracking, it was designed to break. To understand why China is willing to break the global market, you need to look at what's happening inside their own borders. This isn't a financial decision. It's an industrial and strategic imperative. Silver is not a luxury for China. It is the bloodstream of their national project. Every single solar panel rolling off a Chinese production line contains about 20 grams of silver paste. It's the most conductive element on Earth, and it's irreplaceable for creating the efficient electrical pathways that make modern solar technology work. China is building 700 gigawatts of new solar capacity. That number is almost impossible to visualize. It requires billions upon billions of grams of silver, a demand stream that is permanent and non-negotiable. If the silver stops, the solar expansion stops. Then there are electric vehicles. China produces 60% of the world's EVs. Each one uses between 25 and 50 grams of silver, up to 79% more than a traditional car. Companies like BYD are deep into research on next-generation silver-based solid-state batteries. That demand is only going to increase. This metal is baked into the core of their automotive dominance. And it doesn't stop there. The rollout of 5G infrastructure, the construction of AI data centers that consume immense power, all of it requires silver. It's in the switches, the connectors, the components where reliability and conductivity are paramount. China's entire technological ascent, its bid for leadership in the industries of the future, is dependent on a steady, secure, and massive supply of this one metal. So when you see that export license requirement, you have to see it through this lens. The annual revenue from exporting 6,000 tons of silver is around $5 billion. For China's economy, that is a trivial amount. The cost of having their solar panel or electric vehicle production lines idled because they exported the silver instead. That cost is incalculable. It would jeopardize their energy security, their industrial policy, and their geopolitical standing. The green energy transition is not an environmental slogan in China. It is a national security directive. They view control over the critical inputs for that transition with the same seriousness as a military strategy. This is resource nationalism in its purest form. The domestic need to power their own factories, to build their own infrastructure, to secure their own technological future, completely and utterly trumps any short-term benefit from export revenue. The West made a critical error in analysis. They looked at the silver market and saw a financial asset, a commodity whose price could be managed with paper contracts. Beijing looked at the same metal and saw the foundation of their next 50 years of economic growth. They are not trying to manipulate the price for profit. They are ensuring the physical metal is available for survival. The choice was simple: supply the world and risk your own future, or secure your own future and let the world adapt. On January 1st, they made that choice official. The silver stays home. So where does this 6,000-ton annual buffer actually come from? And why can't it be replaced? The answer reveals the fatal flaw in the entire Western pricing model. China doesn't just mine silver, it refines it. They control 60 to 70% of the global refined supply. That's the crucial distinction everyone misses. Mining is one thing. You dig rock out of the ground. But turning that rock into a 1,000-ounce, good delivery bar that can be delivered to a factory or a mint is a complex, chemical-intensive process. China has spent 40 years building a refining infrastructure that is unmatched in scale and efficiency. They process not only their own mined ore, but also massive quantities of concentrate and scrap from around the world. This 6,000 tons that gets exported annually isn't surplus, it's the float. It's the excess metal that London, India, and the United States have come to depend on to balance their own deficits. London's vaults, the heart of the paper market, are largely filled with metal that originated in a Chinese refinery. Indian jewelers and silverware manufacturers source the bulk of their raw material from China. The entire system is built on the assumption that this tap is always on. And here's the critical point other producers cannot solve: refining capacity. A mine in Peru or Mexico can increase output over time, but where does that raw ore go to be turned into investment-grade bars? The smelters and electrolytic refineries simply do not exist at the required scale outside of China. Building a new refinery is a multi-billion-dollar, multi-year project fraught with environmental and regulatory hurdles. It is not a 2026 solution. This is the anatomy of the break. The global supply chain isn't a web, it's a funnel. And for the last decade, that funnel has narrowed directly into Chinese port cities. The paper markets in New York and London priced silver as if the metal was abundant because the paper claims were abundant. But the physical reality was always a single, fragile pipeline. On January 1st, control over that pipeline shifted from market forces to a government ministry in Beijing. The flow hasn't just slowed, its very purpose has been redefined from commerce to strategy. The West priced the paper. China now controls the metal. And in a dislocation, the metal is all that matters. While the mainstream financial press was still writing off Announcement 68 as a non-event in early November, the people who move actual metal were already reacting. The smart money doesn't wait for headlines. It reads the fine print and watches the flow. And by mid-November, the flow was already changing. The first signals came from Shanghai. Refineries that had exported silver for decades, the small and medium-sized operations that form the backbone of the trade, began reporting that their license applications for 2026 were stuck. They weren't being rejected outright. They were placed under review, a bureaucratic limbo with no defined timeline. This was the first concrete evidence that the licensing regime was not the rubber stamp process the analysts had predicted. The door wasn't just being monitored, it was being closed for all but a select few. Simultaneously, a different pattern emerged. The state-owned enterprises, the giants with direct lines to the Ministry of Commerce, began receiving preliminary approvals. But these approvals came with strings attached conditions that revealed the strategic intent. Export only to friendly nations. Report the final destination and in dues for every single bar. The metal wasn't just a commodity anymore. It was a tracked asset, its movement a tool of state policy. This two-tiered system was the real warning. It wasn't a blanket ban, it was a controlled constriction. The market for Chinese silver was being segmented. The reliable, predictable flow that the West had built its derivative, empire upon, was being replaced by a trickle subject to political approval. Insiders who understood this shift didn't wait for the price on the screen to react. They went to the vaults. They started pulling metal out of the Shanghai Gold Exchange, converting paper claims into physical bars while the conversion was still possible. The price action in late November was deceptive. It was volatile but range-bound, leading many to believe the situation was contained. But that volatility wasn't noise, it was the sound of a foundation cracking. The initial wave of physical buying from those in the know was hitting a paper market that was still massively short. Every time the price dipped, it was met with a wall of physical demand from actors who understood that the price was wrong. They weren't speculating on a rise. They were securing an asset they knew was about to become unobtainable. The Thanksgiving breakout to $60 wasn't the start of the move. It was the moment the pressure from these early warning signs became too great for the paper market to suppress. The smart money reaction in November was a quiet, deliberate accumulation of physical metal based on a simple conclusion. The system described in Announcement 68 was not a market mechanism. It was a choke point. And once it was activated on January 1st, the price on the screen would become completely disconnected from the cost of securing the actual metal. They saw the fracture line in the system. They positioned themselves on the side of physical reality before the gap became a chasm. That pressure from the smart money finally detonated on November 28th. While the United States was observing Thanksgiving, silver broke $60 an ounce for the first time in history. This wasn't a gentle crossing of a threshold. It was a violent breakout, a price surge that should have triggered a massive wave of buying and short covering. But it didn't, because at the critical moment, the market simply stopped. The COMEX, the New York exchange that sets the benchmark price for the Western world, experienced what was officially described as a cooling system malfunction. Trading was halted for 6 hours. In the middle of a historic supply-driven breakout, the primary pricing mechanism for an entire asset class went dark. You need to understand something about modern financial infrastructure. These systems are not built to fail. They are engineered with immense redundancy to survive everything from power outages to cyber attacks. A 6-hour halt during the most critical price discovery moment in decades is not a technical glitch. It is a controlled intervention. It is the equivalent of turning off the scoreboard in the middle of a championship game because one team is scoring too many points. This pattern is not new. During previous delivery squeezes in other metals, we've seen similar coincidental outages. They are a mechanism to prevent a cascade. When a price moves too far, too fast, it triggers margin calls for the massive short positions held by the bullion banks. If those banks cannot meet the calls, the entire paper structure collapses. A trading halt freezes that process. It gives the institutions on the wrong side of the trade time to regroup, to find liquidity, to avoid immediate failure. But this time, the halt revealed something more profound than just institutional panic. It revealed that the paper market's primary defense against a physical shortage is to simply cease price discovery. When the reality of scarcity becomes too overwhelming for the fiction of paper liquidity, the only option left is to turn off the machine. The $60 breakout was the market screaming that the physical shortage was real. The 6-hour halt was the system's admission that it could not handle the truth. It was a desperate attempt to maintain the illusion of control while the foundation crumbled. The breakout proved the pressure was unsustainable. The halt proved the system was broken. While the West was preoccupied with paper price movements and technical halts, a different kind of signal was flashing halfway across the world. In early December, India, the world's second-largest consumer of silver, imported 1,700 metric tons in a single month. To put that number in perspective, that's more than India typically imports in an entire quarter. This wasn't incremental buying. This was a panic. Indian manufacturers and investors understood the implications of January 1st with a clarity that Western analysts completely missed. Their jewelry industry, their electronics sector, their deep cultural affinity for precious metals, all of it depends on a steady flow of physical silver. They looked at Announcement 68 and saw not a negotiation, but a termination notice. The flow of metal from China, their primary supplier, was about to be subject to the absolute discretion of Beijing. So they did the only logical thing. They bought everything they could at any price before the window closed. They weren't just buying futures contracts. They were buying physical bars and shipping them out. They paid premiums of $5 to $7 over the supposed global spot price. They organized airlifts from Shanghai and Hong Kong, bypassing slower sea freight to get metal onto the ground in India before the deadline. This frantic buying drained the Shanghai Gold Exchange inventories by 75% compared to just a few years prior. It was a physical evacuation. This is the critical difference between understanding a market on a screen and understanding it on the ground. The Indian buyers weren't looking at charts or analyst reports. They were looking at their own production schedules for the coming year. They knew that without a guaranteed supply of silver, their factories would stall. Their reaction was not based on speculation about price. It was based on the certainty of scarcity. They saw the coming supply cutoff with absolute clarity. And their panic buying was the most honest assessment of the situation possible. They voted with billions of dollars, and their vote was unanimous. The metal is leaving the market. But the Indian buying frenzy was just the appetizer. The main course arrived on December 10th, when reports surfaced of an order so large it threatened to break the market by itself. A major hedge fund, widely rumored to be managed by a billionaire whose name rhymes with Paul Tudor Jones, placed an order for 12,400 metric tons of physical silver. You need to let that number sink in. 12,400 tons. That is more silver than exists in all the registered COMEX vaults combined. It represents approximately 2 full years of the entire global export buffer that China is now shutting down. At current prices, it's 4.2 billion Australian dollars bet on physical metal. And the instructions given to the brokers were simple and terrifying. Get the metal before the Chinese door closes. Any price, the brokers went to work. They went to London, the historic center of the physical bullion market. The answer was no available inventory. They went to Zurich, to the private vaults of Switzerland. The answer was the same. They went to New York, to the COMEX delivery system. The answer there was perhaps the most revealing of all. We can offer you futures contracts, but physical delivery will take 6 to 8 weeks. 6 to 8 weeks. That timeline placed delivery squarely after January 1st, after the licensing regime was active. It was a promise of paper, not a guarantee of metal. The billionaire's response was immediate. The order remains unfilled. This unfilled order is not just a data point. It is a sword hanging over the throat of every bullion bank on the planet. It proves that the physical market has vanished. When someone shows up with billions of dollars, willing to pay any price, and cannot find the metal, the entire pricing mechanism is exposed as a fiction. The system is built to handle small, incremental demands for delivery. It was never designed to handle an order that represents 80% of the entire annual export flow. This was a stress test. The system failed catastrophically. The order's existence signals that the smartest capital in the world has reached the same conclusion as the Indian buyers, but on a scale that dwarfs all other demand. They aren't betting on a price spike. They are trying to secure a finite physical asset before it becomes politically unobtainable. The fact that the market could not fill it tells you everything about the true state of the vaults. They are empty. The paper price is a ghost, trading in a market that has run out of the very thing it is supposed to represent. This unfilled order is the ultimate confirmation that the disconnect between East and West is permanent. The West can print contracts, it cannot print silver. And now, the biggest players know it. While the West was struggling with unfilled orders and empty vaults, the real panic was happening inside China itself. And it manifested in two unmistakable signals: backwardation and regulatory intervention. On December 12th, the UBSSDIC Silver Futures Fund, the primary way Chinese retail investors play the silver market, surged 60% in just 2 weeks. But the price of the fund became completely detached from the value of its underlying assets, trading at a 20% premium. Investors were paying 120 yuan for a fund holding 100 yuan worth of futures. This is the very definition of a mania, a buying frenzy driven by the certainty that domestic prices were about to explode. The Chinese regulators saw this and panicked. They halted trading for an hour. When it reopened, they imposed drastic measures, slashing the subscription cap from 500 yuan to just 100 yuan per investor. They were trying to cool the speculative fever, but you can't cool a fire when the fundamental fuel is infinite demand meeting finite supply. This was the government trying to put a lid on a pressure cooker that was already at its limit. The real technical breakdown was happening in the market structure itself. By mid-December, the Chinese physical market went into backwardation. Normally, you pay more for a futures contract that delivers in 3 months because there are costs to storing metal today. But in backwardation, that relationship flips. The price for immediate physical delivery trades at a premium to the future price. It's the market's way of screaming that there is a critical shortage of metal right now. And that's exactly what happened. Chinese silver futures for delivery in March 2026 were trading around $74 an ounce. But if you wanted a bar of silver you could take out of a Shanghai vault that same day, the price was $82. An $8 backwardation. This isn't a market quirk. It's a systemic failure. It means that industrial buyers, the ones who need silver today to keep their production lines running, are so desperate that they will pay a massive premium to avoid waiting. They know that waiting means they might not get the metal at all. The backwardation was the clearest possible signal that within China's own borders, the physical scarcity was now dictating the price. The paper futures market was becoming irrelevant. The mania wasn't a rational speculation. It was a logical reaction to a broken system. The trading halts were an admission that the market mechanism could no longer contain the physical truth. By December 23rd, the market was screaming. The COMEX managed to push to a new all-time high of $70 an ounce. But in Shanghai, the price for physical metal closed at 78.49. That $8 gap was no longer an anomaly. It was the new reality. The paper market was chasing a physical market that was accelerating away from it. On Christmas Eve, the pressure intensified. The COMEX inched higher to $72 in thin holiday trading. But in Shanghai, the physical price broke through the $80 barrier. Hitting 80.15, the disconnect widened. The Western market, operating on a skeleton crew, was completely detached from the frantic bidding war happening in Asia. The paper price was becoming a lagging indicator, a ghost of a market that no longer existed. Then came December 26th, the day after Christmas, when Western traders returned for a shortened session. The dam broke. The COMEX spot price exploded, surging over $7 in a single day to close at $79.57. A 9.6% single-day gain. For the year, silver was now up 170%. its best performance since 1979. But this wasn't a repeat of the Hunt brothers' speculative corner. The entire move was driven by one thing: delivery pressure. The paper market was being violently dragged upward, kicking and screaming to converge with the physical price that had been established in Shanghai days earlier. The explosion wasn't a breakout, it was a capitulation. The paper market was finally being forced to acknowledge the reality that the physical market had known for weeks. The gap was closing, but not by Shanghai coming down. It was closing by the Western paper price being pulled into the gravitational field of physical scarcity. The final week of the year wasn't a celebration, it was a reckoning. But this time, it's different. Everyone looks at the 170% gain and the 1979 comparison and assumes this is another speculative bubble. Another paper squeeze that regulators will break. They're wrong. The Hunt brothers episode and what's happening now are fundamentally different events. The Hunts were trying to corner the market using massive leverage in the futures market. They bought paper contracts, creating artificial demand to drive the price higher, betting that the physical supply wouldn't be enough to meet their delivery demands. It was a financial attack on the system, and the system fought back. The regulators changed the rules. They imposed liquidation-only trading, effectively forcing the Hunts to sell their positions. The exchanges raised margins, making it prohibitively expensive to maintain their leverage. The government and the banks coordinated to break the corner. They flooded the market with paper promises and altered the rules of the game mid-play. The price collapsed because the speculative paper pyramid was demolished. 2026 is the inverse. This isn't a paper attack on the physical market. This is a physical shortage attacking the paper market. The leverage isn't coming from speculators. It's coming from the Chinese government's absolute control over the physical supply chain. The demand isn't artificial. It's the non-negotiable need of the global green energy and technology sectors. You cannot regulate away a physical deficit. You cannot change the rules to create silver that does not exist. The regulatory response in 1980 was effective because the problem was too much paper. The problem in 2026 is not enough metal. If the COMEX tried to impose liquidation-only trading today, it would be an admission of failure. It would mean they are acknowledging they cannot facilitate delivery. If they raise margins, it might knock out some small speculators, but it does nothing to the Indian manufacturer who needs metal to avoid shutting down a factory, or the Chinese solar panel producer operating under a national mandate. Their demand is price-insensitive. It's about survival, not profit. The Hunt brothers were defeated by the system's ability to create more paper. The current situation will be resolved only when the paper price rises to a level that truly reflects the physical scarcity, level high enough to force industrial users to cut back or to stimulate massive new mining and refining investment, which takes years. The rules changed in 1980 to protect the paper status quo. The rules changed on January 1st, 2026, to dismantle it. The Hunt brothers challenged the market's mechanics. China has challenged its very foundation. One was a correctable error in the system. The other is a structural break of the system itself. The parallel is a warning from history, but the outcome will be its opposite. The paper market broke the Hunts. The physical market is about to break the paper price. So what happens to the retail investor, the person trying to buy a few coins or bars when this structural break hits? The entire dealer network in the West goes into survival mode. And that's exactly what we saw unfolding in the final days of December. This isn't a matter of high finance. It's the direct, on-the-ground consequence of a broken market. Across the United States, major bullion dealers like JM Bullion and SD Bullion began implementing measures they hadn't used since the 2008 crisis. Premiums on American Silver Eagles, which normally sit at $3 to $5 over the spot price, exploded to $15, $18, even $20 over spot. A coin that should cost $82 was being listed at $95, $97, $100. But the premium hike was only part of the story. The other part was inventory. JM Bullion had 73 different silver products listed as out of stock. SD Bullion moved its entire operation to pre-sale only status. You could place an order, but they couldn't tell you when or if they could fill it. This isn't greed, this is systemic risk management. A bullion dealer's business model is based on a simple hedge. When you sell a physical ounce to a customer, you simultaneously sell short a futures contract on the COMEX. This locks in your profit. If the price of silver goes up the next day, the loss on the physical ounce you just sold is offset by the gain on your short futures position. It's a beautiful, risk-free arbitrage, long as the paper market functions. But when the paper market disconnects from physical reality, that hedge breaks. If a dealer sells you a silver eagle for $85 today and shorts a futures contract at $79, they've locked in a $6 profit. But if on January 2nd, the COMEX price gaps up to $90 because the Shanghai benchmark has jumped, that hedge is now a catastrophe. The dealer is suddenly short an asset at $79 that is now worth $90. They lose $11 on the futures contract, wiping out their profit, and then some. Multiply that by thousands of ounces, and you have instant bankruptcy. So the dealers did the only rational thing. They either priced in the extreme risk of a price gap by charging massive premiums, or they stopped selling altogether. The out-of-stock signs weren't because the vaults were physically empty of every bar. They were because the dealers could no longer hedge the risk of selling you that bar. The suspension of sales was a louder signal than any price chart. It was the market's front line admitting that the pricing mechanism they depended on for decades was no longer reliable. The paper price on the screen had become a dangerous mirage, and to sell physical metal against it was to risk financial ruin. The disconnect wasn't just an academic concept anymore. It was the reason you couldn't buy a silver coin at any price. But the dealer suspensions in the US were just a local symptom of a global hemorrhage. To see the real extent of the physical drain, you have to look at London. The London Bullion Market Association is the historic heart of the global physical gold and silver market. Its vaults are supposed to be the deepest, most liquid pools of metal on the planet. And those vaults are being emptied. In June of 2022, the LBMA reported holdings of approximately 31,000 metric tons of silver. That was the buffer, the physical foundation that the entire paper edifice was built upon. By March of 2025, that number had fallen to 22,000 tons. A 30% decline in less than 3 years. But the real acceleration happened in the final quarter of 2025, as the January 1st deadline approached. The drawdowns weren't gradual anymore. They were a cascade. The most telling metric from London wasn't the inventory number itself, but the lease rate. The lease rate is the cost to borrow physical silver overnight. In a normal liquid market, it's near zero. There's plenty of metal to go around, so lending it out costs nothing. In December of 2025, the silver lease rate spiked to between 8 and 9%. That number is catastrophic. It doesn't mean silver is expensive to borrow. It means silver is unavailable to borrow at any reasonable price. It is the financial system's equivalent of a panic alarm. It signals that the vaults are functionally empty for lending purposes. The holders of the remaining metal will not part with it for anything less than an exorbitant fee because they know they might not get it back. This drain is the physical evidence of everything we've discussed. The Indian buying frenzy, the billionaires' unfilled order, the Chinese domestic hoarding, it all had to come from somewhere. And that somewhere was primarily the LBMA vaults. The float has not just shrunk, it has evaporated. The entire pricing mechanism for a derivative-based market requires a functioning physical float. The paper contracts are priced on the assumption that, in the unlikely event of delivery, the metal will be there. When the float disappears, that assumption breaks. The price on the screen becomes a fantasy, a number traded between parties who know that the underlying asset is no longer available in the quantities the market implies. The 30% drain in London isn't a statistic. It's an autopsy report on the paper pricing model. The patient was dying for years, but on January 1st, the life support was pulled. The London vault drain and the dealer suspensions expose the final fatal flaw in the system. It's a flaw of scale, a mathematical disconnect so vast that its collapse was inevitable. The entire Western pricing model for silver is built on a ratio that is fundamentally insane. For every single physical ounce of silver available for investment in the world, there are approximately 200 paper ounces claiming ownership of it. Let's break down the math. Global mine supply is about 1 billion ounces annually. After you account for industrial consumption, jewelry, and other permanent losses, roughly 500 million ounces are left for investment demand each year. That's the real physical float. That's the actual metal. Now, look at the paper side. The annual trading volume on the COMEX and other derivatives markets exceeds 100 billion ounces. 100 billion paper ounces, layered on top of 500 million physical ounces. That's a ratio of 200 to 1. For 2 decades, this system worked perfectly because it was designed around a single, critical assumption. Almost nobody would ever ask for delivery. The paper claims were just promises, financial instruments to be traded back and forth. The system only needed to facilitate delivery for that one person in 200. It was a game of musical chairs, with one chair for every 200 players, and everyone agreed to keep dancing. But in 2025, the music stopped. The players started looking for chairs. It wasn't 1 in 200 demanding delivery anymore. It was 10, then 20. The assumptions governing the entire derivatives empire were shattered. The system was never stress-tested for a scenario where even a small percentage of paper claims were called in. The vaults were never meant to hold metal for 200 owners simultaneously. They were only meant to service the one. This isn't a market failure. This is a design failure. The 200-to-1 ratio wasn't an accident. It was the entire point. It created the illusion of infinite liquidity. It allowed banks and speculators to trade colossal volumes without ever touching the underlying metal, effectively pricing silver based on financial flows rather than physical scarcity. The price on your screen was not the price of silver. It was the price of a derivative contract that happened to be named silver. China's export control is the catalyst that broke this ratio permanently. By removing the 6,000-ton annual export buffer, they didn't just reduce the physical float. They exposed the paper claims as unbacked promises. The system is now forced to discover what happens when 20 out of 200 people want their metal at the same time, and the vault that was only built for one person is suddenly empty. The paper price is not collapsing because of a lack of belief. It is collapsing under the weight of its own fraudulent arithmetic. The 200-to-1 ratio was always a fiction. We are now watching the market violently reconcile that fiction with a physical reality that is 200 times smaller. The paper market isn't correcting. It's admitting it never existed in the first place. So we arrive at January 2nd. The holiday silence is over. Trading terminals light up across London, Zurich, and New York. And the first thing every professional trader does is not look at the COMEX. They look at Shanghai. Because after a 4-day global holiday with no Chinese exports moving for 2 days, the Shanghai price is now the only true benchmark. It is the price of reality. And the reality is a gap, a chasm. While the West was closed, the physical price in Shanghai, untethered from the paper fiction, has likely gapped higher. Maybe $80, maybe it's $95. That initial number on the screen is the shockwave. It's the moment the entire Western pricing model is declared obsolete. The COMEX price, which closed at $79.57, is now a historical artifact. The market must instantly reprice to this new Shanghai standard. This instant repricing triggers the first mechanism of collapse, the stop-loss cascade. The paper market is built on leverage, and leverage is protected by automated sell orders designed to limit losses. But in a rising market, a stop-loss order doesn't become a sell order. It becomes a market buy order. Think about that. A trader who is short silver, betting the price will fall, has placed an order that says, if the price rises to $85, buy back my position to cap my loss. That order is not a suggestion. It is a programmed instruction. So at 9:30 a.m. in New York, the COMEX opens. The price is electronically gapped up to match Shanghai's $90. In that single instant, thousands of these stop-loss orders are triggered simultaneously. They are not offers to sell. They are desperate, mandatory instructions to buy. They are forced buyers, appearing in a market with zero liquidity. The senior traders, the market makers who provide that liquidity, are still on vacation. The desks are skeleton crews. What happens next isn't a rally. It's a vacuum. There are no sellers at $91 or $92. The only sell orders are sitting far higher, at $100 or $110, placed by dealers who cannot hedge. So the price doesn't climb, it leaps. It vaults from $90 to $95 in a single trade. That new price triggers another, deeper layer of stop losses. Another wave of forced buying hits a market with no sell-side depth. This is a cascade. It is a chain reaction of automated orders blowing through price levels like they don't exist, fueled by the catastrophic positioning of the short side of the market. The move from $79 to $100 doesn't happen over days. It happens in minutes. It is a structural failure, not a fundamental one. The price isn't rising because of new buying. It's exploding because the system's own risk management protocols are forcing a violent reconciliation between the paper price and the physical price. The stop-loss cascades are the sound of the paper market eating itself, a financial auto-cannibalism where the mechanisms designed to prevent a crash become the very engine of the collapse. The reckoning isn't a slow dawn. It's a flashbulb. And when it's over, the entire landscape of the silver market has been permanently altered. The paper price has been dragged, screaming, into the light of physical reality. The stop-loss cascade is a financial event, a breakdown in the paper pricing mechanism. But the real, unstoppable force that will determine the final price is industrial panic. The financial players can be wiped out. The paper market can break, but the factories cannot stop. A hedge fund can close its position and walk away. A solar panel manufacturer facing a production line shutdown cannot. Their demand is not discretionary. It is existential. Consider the scale. A single modern solar panel factory can consume 10 metric tons of silver per month. That's over 320,000 ounces. If that factory runs out of silver paste, the entire assembly line grinds to a halt. Workers are idled. Multi-million-dollar equipment sits silent. Most critically, they breach delivery contracts with utility companies and governments. The penalties for missing these deadlines can be catastrophic, far exceeding the cost of the raw material itself. This isn't about profit margins anymore. It's about corporate survival. So when the purchasing manager for a major solar manufacturer in Germany or the United States logs in on January 2nd and sees the COMEX price screaming past $100, their reaction is not to cancel orders. It's the opposite. They immediately issue new orders with one instruction: secure supply at any price. They enter a bidding war not against speculators, but against every other industrial user who is facing the same existential threat. The automotive sector needing silver for every electric vehicle's wiring and electronics. The electronics industry for every smartphone and laptop. The 5G and AI data center builders. This is where the price discovery becomes unhinged from any historical model. These buyers are not price sensitive. They are survival sensitive. Their pain threshold is not determined by a chart or an analyst's target. It is determined by the point at which continuing operations becomes more expensive than shutting down. For a critical national infrastructure project or a flagship electric vehicle program, that threshold could be astronomically high. They will bid the price to $150, $200, $300. Because the alternative stopping production is a financial and strategic disaster they cannot afford. This industrial panic is the final, brutal stage of the physical squeeze. The financial players provide the initial volatility, the explosive moves that break the paper structure. But the industrial users provide the sustained, relentless upward pressure that establishes a new, permanent price floor. They are the anvil against which the paper price is hammered into a new shape. Their demand cannot be printed away, regulated away, or hedged away. It is the inescapable reality of a global economy that is physically dependent on a metal that is suddenly and permanently scarce. The price will rise until it literally destroys demand by forcing factories to close or products to be redesigned. A process that takes years, not days. The industrial panic is the moment the market stops being a market and becomes a triage unit, allocating the last remaining units of a critical resource to the highest stakes bidders. The financial shockwave on January 2nd is just the opening act. The industrial panic that follows is the main event. The silver explosion isn't happening in a vacuum. To understand its ultimate destination, you have to look at gold. On December 26th, as silver was surging past $79, gold hit a new all-time high of $4,532 an ounce, a 73% gain for the year. That parallel move is not a coincidence. It is the sound of the same structural break happening in the monetary metals complex. Gold and silver move together when confidence in the entire financial system fractures. They move together when central banks are buying, not as a speculative trade, but as a fundamental repositioning of their reserves away from paper currencies. The most critical metric linking them is the gold-to-silver ratio. It started the year at 92:1. It has now compressed dramatically to 57:2-1. That means silver has massively outperformed gold. But this compression is just beginning. Historically, this ratio tells us everything about the state of monetary fear. During the 2008 financial crisis, a period of profound institutional distrust, the ratio fell to 35:1. During the Hunt brothers squeeze in 198, a moment of pure monetary panic, it briefly touched 17:1. These numbers are not ancient history. They are a roadmap. If the ratio were to simply return to the 2008 crisis level of 35:1 with gold at $4,500, silver would be priced at $129. That's not a speculative target. That's simple arithmetic. If the ratio were to revisit the extremes of 198, silver would trade at $264. This is the mathematical gravity that silver is now falling toward. The ratio compression is the market's mechanism for remonetization. It is the process by which silver, the poor man's gold, is revalued to reflect its true monetary role alongside its industrial necessity. This is not a theoretical discussion anymore. The BRICS nations have already launched a new trade settlement currency, the unit, which is explicitly backed 40% by gold. This is a direct challenge to the dollar-based system. When nations begin backing currencies with commodities, they are not just making a financial decision. They are making a statement that faith in unbacked fiat money is ending. And when gold is remonetized, silver always follows. It is the accessible high-velocity counterpart to gold's stability. Central banks hoard gold, but commerce, everyday transactions, and smaller-scale wealth preservation run on silver. The ratio compression is the market pricing in this inevitable transition from a debt-based system to a commodity-backed reality. The move in gold confirms the monetary crisis. The explosive outperformance of silver confirms that the crisis is entering a phase where the scarcity of the metal itself becomes the dominant pricing factor. The $129 price target isn't a prediction. It is the minimum logical consequence of gold's breakout and the historical relationship between these two metals. The ratio is screaming that a revaluation of historic proportions is already underway. When the smart money starts putting numbers on paper, you need to pay attention. This isn't fringe speculation anymore. This is the institutional consensus forming around the mathematical inevitability of the situation. Bank of America, one of the largest financial institutions in the world, just raised its 12-month price target for silver to $100 an ounce. BNP Paribas, another global banking giant, published its own forecast calling for silver to reach $100 by the end of 2026. These aren't wild predictions from anonymous blogs. These are conservative, risk-managed institutions with trillions of dollars in assets under management. They're looking at the same supply deficit, the same Chinese export controls, the same industrial demand profile, and they are arriving at the same conclusion. The price has to go significantly higher. But the $100 target is just the starting point, the institutional baseline. Independent analysts, the ones not constrained by the politics of a major bank, are looking at the same data and seeing a much more explosive outcome. Their forecasts are landing in the $200 to $300 range. And they're calling for it to happen within 6 months, not a year. They're looking past the immediate supply shock and focusing on the remonetization angle, the gold-silver ratio compression, and the complete breakdown of the paper pricing model. They understand that when a market is this structurally broken, the price doesn't gently rise to a new equilibrium. It dislocates. It gaps to a level where demand is finally destroyed, and that level is far, far above where we are today. The common thread through every single forecast, from the conservative $100 to the aggressive $300, is the acceptance of one simple fact: the structural deficit is real. This isn't a temporary shortage that higher prices will quickly solve. New mines take a decade to bring online. New refineries take half a decade to build. There is no quick fix. The price has to rise, and it has to rise dramatically, to force the kind of conservation and substitution that will balance the market. The forecasts are no longer debating if this will happen. The debate is now only about the speed and the ultimate price level. The institutional acknowledgement of triple-digit silver is the final piece of the puzzle. It means the narrative has shifted from if to when, and from maybe to how high. The consensus is forming around a number that was unthinkable just months ago: $129. That's the arithmetic of the gold-silver ratio at a conservative 35-1. It's not a stretch goal. It's the minimum logical destination. This isn't just a supply shock, it's a geopolitical earthquake. The Chinese export controls are one piece of a much larger strategic move, a fundamental shift in how global power structures value and trade essential resources. While the West was focused on interest rates and inflation data, the BRICS alliance was building an entirely new financial system from the ground up. And at its core is a principle the West abandoned in 1971: commodities as money. In October of 2025, the BRICS nations officially launched their new trade settlement currency, the unit. And its architecture is a direct repudiation of the current system. The unit is not backed by the full faith and credit of a single government. It is backed 40% by gold and 60% by a basket of member currencies. This is not a minor technical detail. It is the most significant step toward remonetization of commodities in half a century. It means that when countries trade within this bloc, the value of what they're exchanging is anchored to something real, something that cannot be printed into oblivion. And silver is the silent partner in this transition. We saw the signal in November, when Russia purchased $1 billion worth of gold and silver from China in a single, off-market transaction. That wasn't an investment. That was a strategic acquisition for state reserves. It was a clear indication that within this new framework, silver is not just an industrial metal. It is a monetary asset. It's the poor man's gold on a global scale, the metal that allows smaller nations and a broader population to participate in a commodity-backed system. This is the context that makes the Chinese silver ban irreversible. It's not merely an industrial policy, it's a monetary policy. By locking down their silver, China is not just securing raw materials for its solar panels and EVs. It is accumulating the foundational assets for a new financial order. They are ensuring that when the transition from a debt-based system to a commodity-backed reality is complete, the critical resources are held within their sphere of influence. The move on silver is a defensive action for their domestic industry, but it is an offensive action in the broader monetary war. It forces the entire world to confront a simple, brutal truth. The era of pricing critical commodities through paper derivatives in New York and London is ending. The new benchmark is being set in Shanghai. And the new backing is being established by the collective resources of the BRICS bloc. The $129 price target isn't just about supply and demand. It's the market's attempt to price silver not just as a metal, but as a foundational component of a new emerging global currency system. The separation between paper and physical is now permanent. The price on the screen is becoming irrelevant. This isn't a trading opportunity. It's a structural break. The only question that matters is whether you hold the metal.